everyone, and welcome to Prep CFA. In this video, we are going to go over a question about the weighted average cost of capital or the WACC. This question is from the 2012 mock exam, the morning session. So let's begin. In this question, we have some information about a company and its capital structure. Here we're given some information about the company's bonds. We see that it's priced at par and that they have an annual coupon rate of 9.2%. Next, we're given some information about the preferred equity. We also get some information about the common equity, the risk-free rate, the market risk premium, and the capital structure weight. Finally, we have some information about the company's tax rate. And so after reading through this question, you should have some sort of understanding that the question is going to ask you to calculate the cost of capital from each of the sources. So from common equity, debt, and preferred equity, and calculate WACC from there. Okay, so we know that the formula for WACC is the cost of debt, right? Specifically, it's the after-tax cost of debt times the weight of the debt, right? Plus the cost of equity times the weight of equity, and plus the cost of preferred equity times the weight of the preferred equity. So now, how do we find out the cost of capital from each of the instrument? So let's start with the debt. So we have the after-tax cost of debt. We know the formula for that is the cost of debt times 1 minus tax rate, right? And so what is the cost of debt here? We know the tax rate, but what is the cost of debt here? Well, the cost of debt is normally the yield to maturity, right? So the yield to maturity of the bond, right? In this case, we're not given the yield to maturity, but we're given the coupon rate, which we know is 9.2%. And we know that the bond is trading at par, which means that the yield to maturity must be equal to the coupon rate, right? Because the bond is trading at par. So here we can simply use the 9.2% times 1 minus 35%. This should give us 5.98% as our after-tax cost of debt. Okay. Next, we find out our cost of equity, and the way we're going to do that is using CAPM, right? Because we have all the information from the question to apply CAPM. And the formula for CAPM is risk-free rate plus beta times the market risk premium, which is the return in the market minus the risk-free rate. Here we're given the risk-free rate, which is 4%. We know that the beta is 1.3, and we know that the market risk premium is 11%. Okay? So now we get the cost of equity to be 18.3%. Okay? Finally, we have to calculate the cost of preferred equity. And the way we do that is simply calculating the dividend yield of preferred equity. So the way we calculate dividend yield is 1.35, which is the dividend, divided by the price of the preferred stock, which is 8.18. And we get the answer, which is 16.5%. So now we have all the information we need to calculate WACC. And so we can simply plug in the numbers. We have WACC equals cost of debt, after-tax cost of debt, 5.98% times the weight of the debt, which is given to be 30%. Then we're going to add the cost of preferred equity, which we found out is 18.3% times the weight of the common equity, which is 55%. And then we want to find out the cost of preferred stock, which we know is 16.5% times 15%. And so we get the result to be 14.34%. And so the answer is C, 14.3%. And that is how we calculate WACC when we are given information about the capital weights and the bond yield and the common equity, the beta and the risk-free rate, as well as the market premium.